Hi there, everyone. Good evening and welcome to the Daily Finance Wrap. This is your daily dose of all news that's related to the world of finance. We cover investments, insurance, loans, real estate, and everything to do with your money. I'm your host, Avanne Dubash. And not just that, we've also got expert analysis on the show. So we'll be taking on board your questions live. If you have any, please do comment in the comment box, send in your questions on the YouTube live, and we'll make sure to get them answered. Today, we'll be talking about the different types of mutual funds and whether or not you should be rejigging your portfolio when it comes to mutual funds in a volatile market like this. We have a very special guest as well joining in, Kanika Kapur. She's the founder and chief investment strategist at Spinwealth. Kanika, thank you so much for joining into the Daily Finance Wrap. Lots to cover today, so let's begin then with some of the top headlines and stories. First up, the benchmark indices have made a sharp recovery from yesterday's massive fall. In fact, we do have the US presidential elections that continues to loom large as a big talking point for investors. But the Nifty managed to gain about 200 points. We moved back above the 24,000 mark. The mid and the small cap indices as well were comfortably in the green. Stocks within the metal space like JSW Steel, Tata Steel, Hindalco, they all held out. The likes of Bajaj Auto as well as SBI, they were among the top gainers on the Nifty. While some of the big losers continue to remain in ITC, Bharti Airtel, even Adani Ports and Coal India, they lost out in momentum. But all eyes will be on what the US presidential election outcome is, and the equity global markets are really seeing heightened volatility due to that. There continues to be a bit of uncertainty regarding that poll outcome, and the impact of that uncertainty can be gauged from the fact that the benchmark index Sensex fell as much as 1,500 points during intraday trade just yesterday. Moving right on to other news and updates, the market regulator SEBI has authorized mutual funds to invest in overseas mutual funds or unit trusts that allocate a portion of their assets to Indian securities. The investment is capped at 25% of the overseas fund's net assets, and then this initiative has been undertaken to simplify the investments in foreign mutual funds and unit trusts, to enhance transparency, and to enable mutual funds to diversify their overseas investments, as stated in SEBI's circular. This framework is going to be effective immediately. In more macro news and updates then, India's diesel demand has experienced a stagnation in the month of October. The sales were absolutely flat at 7.64 million tons. That's just a 1.8% rise in the first 10 months of this year, and that's been the weakest that we've seen since the year 2020. Now, this is marking a potential shift in the fuel consumption patterns that we've seen. This comes as the GDP growth as well has slowed to about 6.7% in the June quarter. That's the lowest in the last 5 quarters. We've also seen the industrial production that has contracted for the month of August for the first time actually in the last 2 years. And this can be attributed to a number of factors like a cooling economy, the evolving consumer preferences, as well as raising concerns when it comes to the global oil market. So there you have it. Those are all the top stories on the Daily Finance Wrap. Let's get straight to it and welcome right back Kanika Kapur, who's the founder and chief investment strategist at Spinwealth, to talk about the different type of mutual funds. And we want to understand how these mutual funds play a role in your portfolio, helping investors to meet their financial goals. And I bet everyone has the question, it's such a volatile market right now, should I be rejigging my portfolio when it comes to mutual funds? So we'll get those questions answered, and of course all your live questions in the comment section. But first, Kanika, I want to get to the news that I was just flagging off. The fact that SEBI has come out with those guidelines for mutual fund investing in international funds. Just decode this. What exactly does this mean?
So, Avanne, this has nothing actually to do with the Indian so we wait on clarification. But basically, first there was no specific caps. SEBI has clarified and has mandated that when mutual funds invest in overseas funds, the exposure to Indian securities cannot be more than 25%. And if it is more than 25%, then the mutual funds will be given 6 months to rebalance their portfolios. They have just clarified that.
Okay, absolutely. But
Yeah.
now let's get straight to it and talk about the different types of mutual funds and how are they going to differ in terms of risk return, in terms of potential returns that they could provide. What are the different types?
So basically, I realized that like for a new investor, the various types of mutual funds can be extremely overwhelming. But I'm going to try from my end to simplify it as far as possible. So basically, as far as mutual funds are concerned, they are broadly categorized into three categories: equity funds, hybrid funds, funds. Yeah. When you're love to be a chef and you select the right ingredients and the spices to prepare the perfect dish, right? Equity funds would be like the spicy zest of that dish. You know, they would be like the spicy zest. They are the ones which give you the generate highest potential returns, and they come with a higher reward, a higher return, but a higher risk than the other mutual funds as well, mutual fund categories as well. But and they're more suitable for an investor looking to invest over the long term. Okay. The second type of mutual funds are debt funds. Okay. And they would be like that warm cup of cocoa, very comforting, very cozy. But what is missing is that extra energy or that extra zest, right? So they are extremely stable. They are known to give stable returns and they have lower risk than the other categories of mutual funds. And they do continue to give stability of returns. So that is what is very attractive of them for more or less conservative investors. And they're suitable even for the shortest investment time horizon. Like, say that you want to invest today and you just want to invest for a month or so. They are very suitable even for short-term horizons. And then there is the hybrid mutual fund. The hybrid mutual fund is like the perfectly balanced dish. It is a combination of equity mutual funds and debt mutual funds. So it will invest into stock markets as well, and it will invest into fixed income instruments as well, right? So it will give you the stability which debt funds have, but it will also give you the growth of equity mutual funds. So it is more or less suitable for medium to long-term investments, for a medium to longer term investment horizon. Besides the three broader categories, there are also a lot of other mutual funds, like for gold and silver seekers. There are commodity funds which invest into gold and silver. And then there are also solution-oriented funds, like, for instance, there are special funds for people looking to invest only for the retirement, or special funds for people looking to invest for their children's education. But broadly speaking, I would categorize the mutual funds into these three categories.
Okay, I like the way that you put it, Kanika. It's as per the different flavors that you have. Some foods are comforting, some foods add a little bit of spice, like a little bit of risk in your portfolio.
Yes.
So I guess everyone will want to ask. I mean, you have different moods that you want to eat different foods, right? Sometimes you're just longing for some comfort food. You want to have your basic dal chawal. Sometimes you want to spice things up and going for a new cuisine. So I bet investors as well have different time frames based on the markets. For example, right now we're
Yeah.
seeing quite a bit of market volatility. So how should the investor adjust their mutual fund portfolio to protect themselves against major losses or against any sort of uncertain periods?
Okay, so now the first question you need to ask that adjustment. Do you genuinely need that adjustment? Because, whatever, as investing is a marathon, it's not a so you have to remain focused on your long-term goals and not let like recent movements or short-term price movements unnerve you. Don't let them move away from recent recent price right? But if you are getting worried. You are panicking. It doesn't suit your risk tolerance. You're not sleeping well at night. None of us want that, right? So I would say like move some bit of your funds to more stable funds. Like hybrid funds are way more stable because they have the stability of debt funds. And if you want even more stability, maybe for some time you could move some funds to debt funds, which give you very stable returns. And you won't see as much volatility in debt prices in comparison to equity funds. Um, so, when is it a good time that you do have to adjust is when you actually see that, your investment portfolio has kind of like diverted into a path which is not going to help you meet your investment goals. Like for instance, supposing to meet your investment goal, you've decided that you have to be invested in equity mutual funds, 70% of your portfolio, okay? And there is volatility and your equity funds go down a little bit and now there's 65% of your portfolio. Then maybe you want to look at adding a few equity funds to your portfolio to get your portfolio back in track to meet your investment goals. Yeah, I mean, like, as Morgan Housel says, right, the most important part of a plan is planning what could not happen as part of the plan, right? So that is precisely what it is, volatility.
Absolutely. I guess saving for a rainy day, and that's what investors need to do when it comes to their financial planning. So, just assuming, Kanika, if we were to make it a little bit simple, if I have a medium risk appetite and I want to partake in what's happening in the markets right now, would there be any specific types of mutual funds? For example, would it be debt funds or equity mutual funds that one should really be investing in? Or in a time that is so volatile such as this, would you advise that there is a specific fund that will tend to perform better?
So during the volatile times, as such, we always advise that, like, we always say that it is best to remain invested in a hybrid fund as they have the cushion stability of a debt product as well in their portfolio. But besides that, what I will say is during volatile times, it is a good idea to add defensives to your portfolio. For example, consumer funds or pharma funds. When there was volatility and chaos post-COVID, the funds which performed the best was the pharma funds. And that is because no matter if there is a recession and no matter how much volatility there is, if you're unwell, you will need to consume medicines. Okay? Even if there is a recession, you're going to get up in the morning and brush your teeth. You're going to need toothpaste. So you're going to purchase something from Colgate. So defensive sectors tend to remain way more resilient and perform better during volatile times. Besides defenses, I feel like in volatile times, large caps can be like a sturdy anchor in your portfolio. They can be like a really sturdy anchor in your portfolio because they tend to be more volatile than mid caps or small caps. So they would be also something you could probably look at having in your portfolio.
Okay, a sturdy anchor, and who wouldn't want that in times of volatility? Guys, do remember, whoever's watching, we are with Kanika live, and if you've got any questions on rejigging your mutual fund portfolio, if you want to ask about different types of mutual funds, what to do in a market like this, there's a comment section, so do post your questions and queries, and we will get them answered. All right, so Kanika, I just want to understand, and I'm sure this is a pretty common question that you do get asked, actively managed funds versus passively managed funds. What do you think is better, especially in times of volatility, and why?
I wouldn't say either one is better. What I would say is both come with their own set of advantages. Yeah, it just depends on the strategy you want to take. Okay. Like imagine, for instance, you can imagine the market to be like a dragon out of Game of Thrones, right? And so your active funds would be like an experienced knight, right? Because there is an active fund manager who's experienced. He's experienced in making adjustments and he's trying to outpace the dragon and he's trying to outpace the agility by making by making adjustments which he has learned over the time from experiences, and he is there in real time analyzing and making those adjustments. Okay, and as far as passive funds are concerned, okay, they are like the wise old sage. They have the steadfastness and the steadiness. They come with the advantages that they are diversified because they have to invest into everything that the index holds. They come with low expenses. They have a lower risk because they have to mirror the index. Yeah. So it depends on the strategy you would like to take. Would you like to be the experienced knight or would you like to be the wise old sage? It is not either or is better. Both come with their own set of advantages.
I love the analogies, the wild old sage or the dragon. You need to decide basis your risk appetite, basis your financial goals and your needs. And I think Kanika put it perfectly. Like I said, we are live. So if you've got any questions when it comes to mutual fund investing, this is your opportunity. You can get them answered live. Well, we do have one question from Akash Kotian, and he's saying, is it better to invest in hybrid funds or in debt funds and equity funds separately?
Uh, See, that completely depends on, I would suggest that you should do all three and not stick to one category because it is always a good idea to have a good diversified portfolio. What you need to do is set out what your investment goals are, do your risk tolerance, and based on that, determine your ideal asset allocation. And some bit of your portfolio which goes into equity and some bit which goes into debt. Instead of putting it into separate equity funds or separate debt funds, combine that proportion, those percentages, and put it into an hybrid fund. The reason I say this is because if you do not get to do a sector choice or a market cap choice if you are doing probably a hybrid fund. Yes. So that is something you would probably get to do if you are doing pure equity funds. So this way you get an idea of how you can probably create a portfolio which is your ideal asset allocation and has all kinds of funds. So that will be like a marathon towards your investment goals and not like a sprint which will just get you panicking every time there's volatility.
And that is so critical, isn't it? Especially in times of market volatility, that you need to ride out the storm, and it's not a race, it's a marathon. So I guess a combination. And Akash, I hope we were able to answer your question from Kanika. If we could just scratch the surface a little bit further, and I want to delve a little bit more into Akash's question. You're talking about a combination of these different types. What do you think that for a medium risk appetite investor would be the ideal allocation to hybrid equity and debt funds?
I wouldn't stick to a certain allocation. I always say that an allocation has to be customized to every investor because an investor is unique. Every investor is unique. What might sound crazy to me might make perfect sense to you. And the reason I say this very importantly is more often than not, I receive a call. Say Rohan calls me up, okay? Rohan calls me up and he says, oh, my friend invested into small cap mutual fund and it did very, very well. So I also want to put my money there, okay? Rohan has a son and he is investing for his son's education. His friend does not have any dependents, and he is investing to go on a vacation in the next 6 months. Do you think it would be appropriate for both of them to have the same allocation? Because their risk profile is different, and so is their investment goals. So it's not only about the risk profile, it's also about your investment goals. It's also about your investment term horizon. But for a medium investor, I would definitely say that the majority allocation should be towards hybrid funds and followed by equity and debt funds.
Okay, I hope we were able to answer your question just a little bit further. And do remember, if you've got any questions or queries, please feel free to fire away. We've got Kanika live with us, and we're helping you out, talking about the different types of mutual funds and what you should be doing to rejig your portfolio and protect yourself in times of volatility. So I just want to understand then, Kanika, do you recommend any mutual fund strategies or any types of mutual funds that investors can look at, particularly those who are looking to weather the storm, who have a long-term investment time horizon of the next 5 to 10 years?
I don't particularly recommend anything, but I would definitely tell you one thing. If you want to weather the storm, the best long-term wealth creation strategy is to invest into a large cap fund. Now, why do I say this? The reason behind me saying this is that not only will you weather the storm, because they are like large caps are a sturdy anchor and they are very much less volatile in comparison to small caps or mid caps. But the reason behind me saying this is not only will they help you weather the storm, but they will also help you create wealth in the long term, because these are the largest companies of our country. We have been consuming their products all our lives. Okay? The biggest game changer in any wealth creation strategy is when, from a consumer, you decide to become an owner. You decide to own some part of these largest companies of our country and become a part of the largest India growth story. You actually get to be a part of the India growth story that everybody is talking about. No, not only Indians, if you travel abroad, even foreigners want to participate in it. And you have the first hand at participating in it. So that is one strategy I would definitely recommend. Another strategy I would recommend to weather the storm is a multi-asset allocation fund. That is because supposing there is a wartime, okay, there's a geopolitical crisis going on, like, for instance, Israel-Hamas, there is tension going on, there's tension going on in the Middle East, then there's tension going on with Russia and Ukraine. In these times, gold does better, okay, so the gold proportion of a multi-asset allocation fund will perform better. But in case there is a boom, then multi-asset allocation funds also have equities in them, and the equity proportion of their portfolio will do extremely well. So a multi-asset allocation fund is designed in such a way that it would weather the storm and continue to give you a stable, sturdy return no matter what, because some or the other part of its portfolio would continue to give you performance.
All right, so there you have it. That's how you should be looking at creating a portfolio when it comes to mutual fund investing, in order to make sure that either you're the dragon or the owl, you have the right mutual fund in your portfolio, and you diversify in order to ensure that you are not left high and dry in times of market volatility. Kanika, it's been a pleasure interacting with you. Thank you so much for joining in today. And with that, everyone, we'll wrap it up on the Daily Finance Wrap. Thank you so much for watching. Do stay tuned, 6 p.m. daily to Personal Finance TV. I'm Avanne Dubash signing off.